In two recent Finxter videos, I presented the Market Leader 5 strategy. It's a passive portfolio strategy that actually has shown to outperform the index investing, so S&P 500 investing over long periods of time, like over 25 years or so, by a couple of percentage points in compound annual growth rate. And this can be like, it can make a difference of millions of US dollars if you use a normal savings plan. And I've made these two videos, Market Leader 5 and Backtesting a Winning Investment Strategy. They have, so many people in the community have been quite interested in this, and I got one comment about this strategy, momentum going on, that that I want to address today. So so the wicked way, here he writes, I love the train of thought and so on, and yeah, so the strategy is every single year with fresh capital, with fresh money we make from earned income, say 10K or so, just for reference, if you can only invest 5K, so then divide everything by half. So say we invest 10K every single year. Now we distribute the 10K among the top 5 market cap companies. And so we simply, every single year, in the beginning of each year, we go to market cap, companies ranked by market cap. These are the largest companies by market cap. So in this year, it's Apple, Microsoft, Nvidia, Alphabet, Amazon. We divide the 10K of fresh money among those 5 equally. So we have 2K into each. And then we just wait. We do nothing with the stocks. We simply buy the stocks once and we never sell them. So this was the strategy I backtested, right? So I invest, so if I invest in Amazon, 2K in Amazon in this year, then next year, if it is still in the top 5, I will invest 2K as like another 2K into Amazon. And if the year after it's still in the top 5, I will invest another 2K. And then if it drops out of the top 5, I won't invest fresh money into it, but I will still keep the stock because it could come up again, it could rise again, right? But obviously, like the obvious question now, but a very good question, was issued by the wicked way. What happens if you actually sell the company that falls out of the top 5 market cap status? Because like we assume it has become a loser, right? If it drops out of the top 5 market cap companies, so if Amazon starts to drop out, we assume it's now a loser, right? It's one of the losing stocks. It loses against our top 5 market cap companies. So basically another one comes in. We buy the other one in both strategies, right? But what if we sell the loser and buy more of all the others, right, in the next year? Because say we have accumulated a sizable position in Amazon, but now Amazon drops out and a new company is rising, say Meta. And now we can assume, okay, momentum is keep going, right? Meta will outperform Amazon in the long term. So basically we have now a lot of fresh capital in addition to the new capital we add every single year from the sale of Amazon stock, because Meta, say, has now risen to the top into the top 5 market cap. And the new fresh capital we can now, from the sale of Amazon stock, we can now distribute among the top 5 market cap companies. So we basically allocate more to the winners, and we keep cutting the losers. And this is like, I didn't pursue this strategy in the original top 5 market leader 5 strategy. So there was no rebalancing because I didn't want to incur any capital gains tax. This is the main reason, because if we sell stocks, so say we still had gains with the Amazon stock, we sell the stock, now we have to pay capital gains on our stock, on our stock sales, right? But as was rightly pointed out, if you have, say, a Roth IRA or Roth 401k, and a no-fee brokerage, we don't have any capital gains tax, and we don't have any trading costs, right? So we can just do it. We can just sell the stock. There's no disadvantage to selling the stock and accumulating more of the winners. And so this is a great strategy. So I thought, okay, I will create a variant of this strategy. So I did some coding and developed this additional strategy. This one is the additional strategy. So now basically this one, the run rebalancing strategy. It's the same strategy, but basically we only, at each point in time, we only have 5 positions, because we sell all positions that are not top 5 market cap, and we buy equally weighted. So to no, actually no, it's not this way. It's just if the position drops out of the top 5 market cap, only then we distribute the money among the top 5 market cap companies. But we don't like equally weight or rebalance the strategy, the positions, right, in a given year. So the only change we make is that if a company drops out, we take the cash, we sell it, we take the cash and put the cash back into the top 5. So let's see how this performed. I actually did it for the years. I backtested for the years between 1990 and 2024. It's like 34 years. This is the maximum range I could do with my data, with the data I have. So it's like 34 years. So if you run the strategy, we get, let's maybe first have a look at the graphics, at the charts here. First at the portfolio allocation. So no, this seems a bit broken here. Okay, so this second one here, this big, let's make it a bit smaller. So this big blue pie is basically our strategy. So as you see, we have a significant overweight of the winning company Microsoft, because Microsoft was just so long in the top 5 index, and we never do any rebalancing, right? We just let the winners ride. This idea of the strategy, and by letting the winners ride, there was one significant winner in the last couple of decades that we never sold, Microsoft, because Microsoft always was in the top 5 companies. That's why I accumulated more and more Microsoft stock, and the position becomes heavyweight Microsoft. And this is the main disadvantage compared to the original top 5 market cap strategy, that you see we still have a heavyweight Microsoft position, 39.5% Microsoft, but we also have accumulated a large amount of other winning companies. Some of them actually are not like top winners, right? They are not top 5 winners anymore, right? But they have been at one point, they have been winning, they have been in the top 5 market caps. So the risk, basically the risk is much smaller, the risk of a single position dominating the portfolio. Okay, but this is obviously the advantage, that we have more diversification with the original top 5 market cap strategy without rebalancing. But if you use the strategy with rebalancing, so basically, no, I should not say rebalancing, because we simply we always hold only the top 5 market cap in the second strategy. Here you see our second strategy compared to the S&P 500. This is a dashed line. The S&P 500 is a dashed line. It makes like roughly 1.7 million. So if we invest 34 years in the S&P 500 using this 10K a year addition, then we would have 1.7 million. But with our rebalance top 5 strategy, we would cross the 3.5 million mark, right? But you can also see how the composition of it. So if you look at the composition, so how does it actually happen? You see it's mostly Microsoft, because we have this like more than 80% allocation of Microsoft, because like Microsoft was just one of the big winners, and it has remained in the top 5 market cap for such a long period of time. And we didn't do any diversification, i.e. Selling the winner in order to buy more of the non-winners, right? We simply accumulated more of the winning stock, which was Microsoft. But this basically is like, it's like an automatic stock selection strategy, right? That converges over time to the extreme winners. But there's also a big like a significant story in this whole picture, because you see our so in the end, like after 34 years, of course, our strategy is winning, and it was also winning between 1990 and 2007. But then in 2008, basically we had a different dominant stock, and this was the Citigroup stock. Here you see in green the Citigroup stock. It also had this 80% weight in the portfolio, 70 to 80% weight, the single stock, because it was outperforming all the other stocks. It was one of the top market cap companies, but then it crashed significantly, right? So this is kind of our worst case happened. We have our extreme winner, and that now the extreme winner basically crashed and actually crashed out of the top 5. So we sold the position, but we still took on a lot of losses by waiting for it to drop out of our top 5. So there was a period of 7 years, 7, 8, 9 years or so, during which the S&P 500 actually fared better than this strategy of only focusing on the top 5 and selling the ones that drop out. So you see this, I would say it's a higher risk and sometimes higher return strategy, because we always focus on the winner. We actually take all the gains of the winners, but if the winner then turns out to crash, we have a problem, right? And we might underperform the market for some period of time. And we can actually see this story unfold, right? We can see here how we smoked the S&P 500 strategy, and our returns were like 3x better or so in nominal value for a long period of time, like for 17 years. But then we had a decade or so of underperformance, because our heavy bet actually turned out to be a losing bet. But during that time, we still kept accumulating Microsoft. Here you see the Microsoft accumulation pattern in this greenish curve. I'm a bit colorblind, so please excuse if I didn't identify the color correctly. You see how our Microsoft bet actually now turns out to become a winner, right? So over time, I think this strategy, pointed out by the Wicked Way, actually there might be something onto this strategy, because we automatically always pick the winners. So actually our bet is, we don't bet on a single company. We only bet on the fact that there is one super proportional winner in our top 5 market cap companies. And the top 5 market cap companies are the most powerful, best companies on the planet in a way, right? Because they have become the biggest companies on the planet. So they must be the best. And this top 5 strategy actually automatically chooses over time the one company that outperforms all other companies. And it does so repeatedly. So it does this twice during this long period of time, right? In the first period, it automatically chooses the Citigroup company, and it bet heavily on the Citigroup company, but it also had the bets on Microsoft and so on. And over a long period of time, it identified the winners correctly, right? Because Citigroup was winning until it wasn't, right? And when it basically came down, and this was not sure, right? Citigroup could also have kept winning. We don't know. The strategy doesn't know. The stock selection strategy doesn't know. But it correctly identified the top companies, and it it did ride the wave while it was winning. And then if we started losing, it basically sold it. Not at the best period of time, but when it just dropped out of the top 5 market cap companies. We only checked this once per year, so we had significant losses along the way. But we also accumulated Microsoft for this whole period, and Microsoft then turned out to become the winner, and we benefited massively by accumulating more and more Microsoft every single year, because it remained in the top 5 market cap companies, right? So the strategy in a way automatically identifies this winner and then bets heavily on the winner, and it's an interesting variation of our previous strategy. Our previous strategy, I would say, is a bit more robust, but because here you can see the blue line now shows this is like the first strategy where we don't do any selling of stocks. We just accumulate. We never sell and never rebalance any position. Even if you drop out of the top 5 companies, we just keep it. We just keep the flowers bloom in a way, right? And we never cut any dead weight, so to say, because we always assume that a company that drops out once, it might come back or not. So we simply don't do any selling, don't do any trading. So we still have Citigroup at the end of this whole period, right? In our first strategy, because we always keep positions. So we write Citigroup to zero, but we also like have the Berkshire companies and like Cisco companies, Intel companies. So we still have a large amount of positions. You can see this here again. Still have a large amount of positions, and we are staying more diversified. But obviously we also own a lot of companies that are not outperforming all other companies. So many of them have been winning at a past point in time, but never came back, right? And you can see here Microsoft is still a big position, and we also captured many of the gains of Microsoft with this strategy, but not as many, right? Our Microsoft position is only like 1/3 or maybe 40% of our portfolio. Still weighing heavily to our portfolio performance, but it was like the worst case if Microsoft now came down for one reason or the other, we wouldn't be that much affected as in the other strategy. But obviously, as we don't bet heavily on the winners, we also have a risk of not making any gains. But like the beautiful thing in this first curve is that it always remained superior to the S&P 500. You see, there was always like the gains, even with the Citigroup crash, the gains of our strategy were still higher than the S&P 500 gains. So here and a dashed line. But we did not have this pronounced outperformance in the strategy. So we can see the portfolio values here. Portfolio value at the end of 2024 for our first strategy, never selling any stock, is 2.2 million. If you do the rebalancing, we actually have 3.5 million. So the strategy proposed by the Wicked Way. And if we simply invest in the S&P 500, we have 1.7 million, which is also great, right? So nothing of this is investment advice. This is just back testing one period, the longest period I could. We could like now back test different decades and analyze the performance in different market environments. But I mean, I should say that in this back testing exercise, we actually had multiple periods of significant stress, such as Citigroup going to zero. We had the 2008 crisis. We had the 2000 internet crash and boom. And we have multiple bear marks. We have the COVID crash 2020. So we have had a significant stress during this period. So it's not just a bull market strategy. The strategy seems to be very robust, even against crashes that are threatening to the whole financial system. So these are, I think it's a very robust strategy, and we have significant outperformance. If we do the CAGR calculations, maybe let's do this quickly live. I didn't do it before. So here is the strategy. No, I cannot. I actually cannot. Can I do it? Let me quickly check. Docs. So let me quickly open my recent docs so I can get the compound annual growth rate during this 24 years time frame, because this would be interesting, right? So here we have the our back testing table. Let's make this a bit smaller. Okay. So now it's between 1990 and 2024, it's 34 years, right? So we need to stretch this out to 34 years. So how many years do we have now? This is 28, so we still need seven more rows. 1, 2, 3, 4, 5, 6, 7. Okay, so now this should be 35 numbers. Okay, so somehow I forgot 2. No, 34, right? Okay, sorry about that. So let's remove them. Okay, and now the question is, what is our return? We simply choose the return once. We invest 10K every single month, every single year, sorry about so every single year we invest 10K. We track our investment. We have a certain return percentage that we get in a given year, and we want to determine the compound annual growth rate under these assumptions. Our portfolio value at the end using the rebalance strategy is actually 3.5 million. So we need to adjust the returns to get to 3.5 million at the end, right? If you have a 30% return, then after there's some mistakes. So sorry. So let me quickly fix the mistake. We simply pull this down here. Okay, so if you had a 30% return over this long period of time, we would basically end up with a $250 million portfolio. So this was not the correct rate of return, right? So let's try 20%. If you have a 20% return, we would end up with a 24 million portfolio. You see the power of compounding happening here. So basically, if you have a 15%, we would end up with 7.6 million. So even 15% is too bullish. Here we have a 12%, and this gives us roughly the 3.5 million we wanted, right? 3.56 million. So probably it's like 11% or so. It's even like 11.5% or so. So with a 11.5% return, we would get like roughly a 3.5 million investment in the end after a lifetime of investing 34 years using this adjusted strategy. This is basically the best strategy, and but also the highest risk strategy, because we always bet heavily on one stock. The other two strategies, like for instance our market leader 5 strategy, yielded 2.2 million. So we need to reduce the return from 11.5 to say, so what happens if you have 10%, we roughly end in 2.4 million, right? So we have roughly a 10% yield. With our market leader 5 strategy, we have 10% yield against the 11.5% yield. And if you have the S&P 500 or so, it would probably be like a 9% or so, ending up in even a bit less, like maybe 8.5% or so. So this would be the S&P 500 yield, kind of, right? 8.5. So the difference between our strategies would be like 1.5%, right? So we have the S&P 500 yield, the compound annual growth rate of 8.5%. If we take our market leader 5 strategy, very simple strategy, we never sell anything, we can outperform this and actually get to 10% yield historically using backtesting. And if we use this heavy weight on the winners, then we have higher risk, but we also have a higher yield of 11.5%. Okay, so I thought, let's try the strategy. Let's discuss the strategy quickly. It looks interesting. Everybody needs to do their own investment decisions. This is not investment advice. Thanks for listening to this video. If you like this type of videos, then give me a like and subscribe to the channel. I want to grow the channel. I have been doing a lot of new videos recently, and yeah, I focus these days. I focus on investment videos, like about using ChatGPT to actually get an edge in investing, and this is one of the ways we're doing it. But I also like analyze AI companies. The main purpose of the channel is to help you be on the right side of change, and I focus on investing because, in my opinion, investing is the best bet you have to be on the right side of change. The global economy is labor plus capital. Labor is becoming abundant and cheap through AI agents, humanoid robots, large language models, and self-driving systems. So if you only rely on your own human labor, you will be on the wrong side of change, right? Because AI is coming for your job, for your task. And the only way to protect against this is to focus on the capital part of the economy, to own the AI. And this can be done by, for instance, purchasing stocks or scarce and desirable goods that will also remain scarce and desirable in rapidly changing times. Okay, thanks for watching, and see you in the next video. Bye.